Hey everyone, welcome back to Corporate Decoder, the place where we break down these massive corporate filings and find the juicy bits inside. This week, we're diving into CSX Corporation's annual report for 2025. And let me tell you, it is a dense one, but we'll unpack what it really means for the company and its investors. So what is the headline here? CSX saw revenues dip a bit in 2025 compared to 2024, but operating income took a more significant hit. Stick around as we break down the numbers, the risks, and what CSX is saying about its own future. And before we get too deep, if you love getting these straightforward breakdowns of complex financial documents, make sure you are subscribed and hit that notification bell. Also, we have a fantastic community over on Discord. All the details are in the description below. Let's jump right into the financials. In 2025, total revenue came in at about $14.1 billion. That is a 3% drop from the $14.5 billion they saw in 2024. Now that might not sound huge, but that also translated into a 14% decrease in operating income, falling to just over $4.5 billion. Think about it this way, for every $100 in revenue they made in 2024, they were only making about $86 in operating profit in 2025. That is a big chunk to lose. Looking at the breakdown of their business segments, coal is a big story here. Coal revenue dropped a hefty 15% year over year, which is a pretty significant blow. This was due to lower shipments of both metallurgical and thermal coal, reflecting those global market shifts we've been talking about. Merchandise business revenue also slipped by 1% despite a small increase in mineral shipments that was not enough to offset declines in chemicals, agriculture, and forest products. The intermodal business showed some resilience, growing 4% in volume and 1% in revenue. Now let's talk about what is driving those expenses. Labor and fringe costs nudged up by 3%, mostly due to inflation, and costs tied to employees leaving the company, which was up by about $51 million. Purchase services and other expenses saw a bigger jump of 6%. This was mainly because of network disruptions and congestion, primarily from work on the Howard Street Tunnel and some really rough winter weather. They also had higher costs related to trucking accidents and even some train derailments. Here is a really interesting one, a goodwill impairment charge. For their trucking subsidiary Quality Carriers, CSX had to write down the value of its goodwill by $164 million in 2025 compared to $108 million in 2024. This means they essentially admitted that the acquisitions made in their trucking business are worth far less than they initially thought. This is a pretty clear sign their trucking operations are not performing as expected, and it's a major drag on their bottom line. The bottom line for operating income clearly shows this struggle. Last year, operating income was over $5.2 billion this year. It is down to $4.5 billion. That is a $724 million decrease, which is why their operating margin, which is basically their profit margin before certain costs, also shrunk from 36.1% down to 32.1%. This is a significant contraction and points to challenges in managing costs or generating sufficient revenue from their core operations. Now, let's shift to cash flow. CSX's free cash flow before dividends dropped significantly by nearly $1 billion to $1.8 billion. This was largely due to those lower earnings we just talked about, and also big tax payments from prior years that they had put off. While they are still generating a lot of cash, the decrease is notable. Importantly, their capital expenditures increased as well, with a huge chunk going towards rebuilding the Blue Ridge subdivision after Hurricane Helene. This means more money is going out the door for immediate needs and repairs, limiting flexibility. On the safety front, which is always critical for railroads, CSX did show some improvement. The FA Personal Injury Frequency Index improved by 24%, which is a positive sign. Likewise, their FA train accident rate improved by 13%. These are good trends showing a commitment to safety, but it is important to remember that the sheer scale of railroad operations means even small improvements are hard-won. Now let's talk about what keeps CSX up at night. Their risk factors section is quite extensive. One of the biggest ongoing concerns is regulatory changes impacting their earnings or pricing power. They are heavily regulated, and any new rules from bodies like the Surface Transportation Board could significantly affect their business. They also highlight the constant threat of cyber attacks, a huge risk for any company heavily reliant on technology and critical infrastructure. Like railroads, a successful breach could cripple operations and lead to massive financial and reputational damage. Then there are always the inherent risks of weather disruptions, natural disasters, and even global economic downturns, which can directly impact the demand for their services. Their reliance on other transportation providers for parts of their supply chain also presents a risk if those partners face disruptions. Looking at their leadership changes, Stephen F. Angel took over as President and Chief Executive Officer in September of 2025. Before that, he had a long career in industrials, including a significant stint at a company that deals with industrial gases. His background and experience will be key in navigating the company's challenges. Also, Kevin S. Boone is now the Chief Financial Officer, a role he has held before at CSX with extensive finance and investor relations experience. These leadership moves are happening during a time of financial pressure, which suggests they are aiming to steer the company through these tougher economic waters. Now, for the really big picture, CSX's net earnings for 2025 were just under $2.9 billion. That is down from over $3.4 billion in 2024, a decrease of 17%. Earnings per diluted share also saw a similar drop. While on the surface this might seem like a lot of money, it represents a significant decline in profitability year over year, and it is a direct reflection of the revenue pressures and increased costs we've already discussed. So what is my take on all of this? CSX is clearly facing headwinds. The drop in coal revenue is a major concern given its historical importance to their business. The goodwill impairment in their trucking segment is a red flag indicating that their diversification efforts into trucking are not paying off as planned. While they are making progress on safety, which is commendable, the financial performance is showing a clear slowdown. They are trying to manage costs and invest in infrastructure, but the economic environment and specific industry challenges are making it tough to translate that into growth in operating income and net earnings. The company's direction seems to be focused on efficiency and cost control, which is sound, but the market is clearly not rewarding that strategy heavily right now, given the stock performance graphs, which show them trailing behind major indexes over the last few years. The good news is they still have a strong credit rating and access to capital, but they need to demonstrate a clear path to renewed growth and profitability, especially in their core rail business. The future success will depend a lot on their ability to navigate the volatile coal markets and improve the performance of their other segments. Alright, that is our breakdown of CSX's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to join the conversation over on our Discord community. All the links are in the description. Thanks for watching. See you next time.